US manufacturing is down. Let's have a look. Hello everyone, Florian Heise here, and welcome to another episode of Heise Says. I've got my stein of coffee, and I hope you all had good luck with the Melbourne Cup today. I hope the protesters didn't get you and you won lots of money. Let me know how you did in the comments, guys. You can buy the next round of cheap coffees. Now, I thought we'd have a look at this one article and a little bit of information that has come out from the United States. So Wall Street is closing at record highs and prompts warnings that could be another false dawn. And what we'll do is we'll just look at two things, or three things. The first is United States factory orders, so their PMI. New orders for US manufactured goods fell 0.6% from a month earlier in September 2019, following an unrevised 0.1% decrease in August. So the forward orders for the manufacturing sector in the United States is dropping down. Now the S&P 500, the large capitalization index, is at a record high. It is like, we'll look at the, all data? There you go. From 2004 to now, it's doing pretty well. Another thing to consider, we look here at the data, the actual data. It has fallen -6, was forecast at -4, and the consensus was -0.5. So it is doing worse than expected. Yet the S&P is at record highs. Now let's just have a look here as well at Investopia, just to give a bit of an overview of what the S&P 500 index is for people. So Standard & Poor 500 index. The S&P 500, or Standard & Poor 500 index, is a market capitalization weighted index of the 500 largest US publicly traded companies. The index is widely regarded as the best gauge of large cap US equities. Other common US stock market include the Dow Jones or Dow 30 and the Russell 2000, which represent the small cap index. So these are the big boys in the US economy here. And they've got the, I'll link to this on the references if you'd like to go through the whole thing, but they're weighed, so a change in a bigger company, they've got a way to work it out and to measure the index. So it's a good representation of where they're all sitting. Now, it's an all-time high. Manufacturing has been at the lowest in a long time. So it's not looking good. So let's jump here and go through this. So what this is, a conclusion one might draw is maybe there is a misalignment between the market and reality in some regards, or the market is overly sensitive to the potential for a improved or even any type of resolution to the US-China trade negotiations. And Australia, we're the little country that could, on the sidelines. It's going to be affected by what's happening with these two nations. So let's have a look at this article. US-China trade talks progressing well? Tick. Another strong set of US job data? Tick. Corporates beating earnings forecast? Tick. The Fed insurance rate cut? Tick. With all the boxes ticked, it was little surprise Wall Street closed the week at a record high. It was the third record in 5 days for the benchmark S&P 500. So this article is written on Sunday, so it's a few days gone, but it's still relevant. So green shoots are popping up everywhere. US jobs numbers could not have been much better. Unemployment still near a 50-year low, wages growth a solid 3%, and employment growing by 128,000. A very solid effort given that the 42,000 striking General Motors workers were deemed to be unemployed and those jobs lost. It was certainly taken as a signal US consumers would continue to do their bit to keep the economy from grinding to a halt. US manufacturers seem to be in a happier place too. The latest IHS survey showed a modest expansion in activity, having stalled for a couple of months mid-year. Well, we now know that's not true, do we? Tentative signs of renewed vigor have appeared in the US manufacturing sector, with the survey's production gauge having now risen for 3 successive months to suggest that the soft patch bottomed out in July. IHS market chief business economist Chris Williamson said. Growth of new orders hit a 6-month high, fueled in part by a renewed increase in exports, prompting producers to take on more staff, with payroll numbers rising at the quickest pace since May. In China, there was similarly positive news in manufacturing, although oddly enough, the official PMI survey, focusing on large state-owned enterprises, had a more sour view on things than the private Zan Market PMI survey, focusing on small to medium enterprises. Trade progress, but perhaps the best news came on the trade front. Both the US and Chinese camps were in hearty agreement that things were on track to sign the Phase 1 deal later this month. It's funny how this Phase 1 has just appeared out of nowhere. One could almost be forgiven to assume that might be just created to save face for politicians, perhaps, or am I being too cynical there? The state-owned Xianhu news agency said the world's two largest economies had reached consensus on principles during a serious and constructive telephone call on Friday between their main trade negotiators. White House economic advisor Larry Kudlow was even more effusive, saying while the deal wasn't 100% complete, enormous progress had been made, particularly on the vexing issue of intellectual property rights. I mean, that's the big thing. How much of China's growth and innovation has come from copying? You're going to get a strong reaction from what seems like a deal for now. Again, capital managers John Kilduff told Reuters in New York. This markedly improves the outlook for the global economy, particularly in Asia, where it has sacrificed the most from the fallout from the trade war. Shifting the dials on trade and global manufacturing sentiment saw buy orders flood back into the oil market, driving Brent futures up more than 3%. And haven't we seen this before? But is this conclusive evidence things have bottomed out? Don't be so sure, argues Bank of America global economist Ethan Harris. This would not be the first time green shoots have come and gone. By our count, there have already been at least 6 false dawns in the trade war, Mr. Harris said. Well, yes, it seems like that, doesn't it? It seems like it's a regular thing. It's happening quite often. So why the optimism again, given the green shoots have burned off many times before? Mr. Harris said there are a few things at play. First, some of the improvement reflects expectations coming down to meet reality, he said. Second, as usual, the equity market is sniffing out a potential turn in the economy well before it happens. Sometimes it sniffs out a true recovery and sometimes it doesn't. The market bounce in October probably reflects not just optimism about future growth, but also signs of a skinny deal on trade and faith in the Fed to provide a floor under growth. Third, mini-cycle in inventory may help some companies even as sales remain weak. That doesn't mean things won't get better. Just maybe a bit later than the market is betting, argues Mr. Harris. We still don't expect growth to start to pick up until early next year, with another rate cut from the Fed and further easing in China along the way, he said. The RBA on hold. While the Fed paid for its insurance with another 0.2% cut last week, there's little likelihood the Reserve Bank will do the same at its rate-setting meeting on Tuesday. And as I'll discuss in a later video, they have kept it on hold. The odds of a November rate cut have blown out 50-50 a few weeks ago to now less than 10%. The RBA was given a bit of breathing space with unemployment ticking down a notch to 5.2% and slightly stronger than expected but still weak September quarter inflation. Well, now we've seen as well the retail figures in Australia that have just come out have been lowest since the recession. So what do you think will happen with next month? Or does the RBA do a cut in December? Or do they have a meeting in December? I'll have to have a look. Just how much breathing space may be evident when the RBA publishes its latest quarterly forecast in Friday's statement on monetary policy. Citi's Josh Williamson said he expects very little revision in the outlook after a spate of downgrades in previous updates. This reflects the likelihood of the year-end CPI and unemployment rate forecast being achieved and for the long-run outlook to remain consistent with Governor Lowe's comments that previous rate cuts are helping the Australian economy and supporting the gentle turning point in economic growth, Mr. Williamson said. The only change Citi is forecasting is the RBA cutting its year-end GDP growth forecast from 2.5% to 2.25%. Given it's already November, if the RBA forecasting department can't nail it from here, they may need to invest in some new software or calculators at the very least. Well, and the retail reality check. Leaving aside the RBA and its musings, retail data may be just about as significant, with both quarterly and monthly sales figures out on Monday. Given domestic consumption accounts for almost 2/3 of the economy. And just dwell on that, guys. Just dwell on that. They are important pieces of the puzzle. Backtracking a bit, June quarterly retail sales were, in the words of Westpac Chief Economist Bill Evans, dismal. They rose just 0.2%, taking annual growth up 0.2%, which is a fair indication of how 3 quarters went before. In short, weaker than the GFC and the slowest growth in retail sales since Australia's last official recession in the 1990s. Mr. Evans said despite the rate cut and tax refunds, the September quarter numbers will not show a significant improvement. While slightly positive, the gains are lackluster given the scale of the policy boost to disposable incomes, the combined effect of rate cuts in June and July, and the tax relief from July 1 adding around $3 billion a month through Q3, he said. As it stands, the cash splash is barely a trickle for sales so far. Well, yes, we've definitely seen that. The external side of the ledger will be the focus on Thursday's trade figures. Exports are still booming. The trade surplus will still be large, forecast to be around $5 billion in September, but well down from the record of almost $8 billion in June. Of course, iron ore prices dropping back was always inevitable, falling from around $120 a tonne to $90 a tonne as Brazilian exports resume. But with commodity prices looking challenging across the board, the June record may not be threatened for some time. On the housing front, Friday sees the release of September loan approvals. While some of the housing data has been mixed, the general vibe is things are ticking up again with turnover and price rises since June. So this is all the information that is going to be released this week. We've got the market rate decision, market prices less than 5%, and AGMs, borrow, and we'll go through that at a later time. So guys, here we go. It's interesting to see some of the concerns with regards to the US economy. And yeah, I think it is, the S&P is looking for hopes of a recovery, and a lot of that is to do with just the negotiations of this phase 1 trade deal. And Australia is just, floating along in the sides, and we'll see how it goes. So guys, thanks for watching. Like, share and subscribe. And thank you to all my Patreons who help support the channel. If you like the content I'm producing and would like to help me produce more, I have a Patreon subscribe star, PayPal and affiliate links. And thank you all very much to the generous PayPal donation that came in earlier today. Take care everyone, and I'll talk to you later.